Let's get to some earnings now because Amazon's fourth quarter results are just hitting the wire. You can see we're dropping initially here a quick 8%. Q4 EPS, $1.95. The street was at $1.96. It looks like Q4 net sales, I see $213.39 billion. The estimate was $211.49 billion. Q4 AWS net sales, XFX, up 24%. The estimate was 21%. Just to break that out, it looks like that was $35.58 billion. The street was at $34.88 billion. Q4 operating margins, 11.7%. That looks smack in line with what the street was looking for. I'm looking for Q3 North American net sales. There it is, $127.08 billion. I'm looking for consensus was $127.08 billion. Now let's spin ahead. Q1 net sales. They're guiding for between $173.5 billion and $178.5 billion. The street was at $175.54 billion. And now, of course, we want to look for that CapEx number. 2026 forecast for CapEx. Amazon is saying about $200 billion. The estimate was more like $146.1 billion. That, I think, helps explain this quick move lower, 9%. Remember, heading into this print, this stock had already been under pressure over the past 12 months. It was actually in the red. It was down about 5%. Now, some on the street had argued, including on this show, that was an opportunity, they said, because that was simply a more attractive setup into the report, that it was trading at a big discount to peers. They like what they see with AWS. Marking return to the AI game. They believe the consumer would remain resilient. That CapEx number, though, $200 billion, is going to get a lot of attention. Remember, yesterday, Alphabet certainly made headlines. They gave a CapEx forecast as much as $185 billion. So that's getting attention. Right now, heading into this print, the stock was down over the past 4 months. We're down now nearly 11% here in the after hours, despite the fact that the bullishness on the street for this name is impressive. You've got about 95% of analysts who are paid to tell you what to do with the stock who say Amazon is a buy. So remarkably bullish on the street, but at least initially here, investors have some real questions about this report and the guidance. We got that CapEx guide. Arun, we're talking about $200 billion. It's a number that's hard, I think, to get your head around, Arun. You got a strong buy on this name. We're down here a quick 10% in the after hours. Give me your take, Arun, your first impressions on the print and the forecast.
Yeah, thanks for having me. Yeah, no, I mean, overall, I think the one big positive here is that AWS acceleration. You know, we wanted to see acceleration. We got that last quarter. We saw further acceleration this quarter. We got 24%. I think the street was looking for around 21, 22%. So that was a big highlight there. Yeah, I think the shares are down because of that CapEx number. We were estimating around 140 billion in CapEx this year. It looks like it's going to be around 200 billion. That's much higher than our estimate, much higher than street estimates. But given what Google said last night, it shouldn't be that much of a surprise that the CapEx figure is above consensus. But yeah, 200 billion is quite a lot. I think it's about a 50% increase from 2025. And 2025 was about a 60% increase from 2024. So some significant spending ahead. But clearly, I think Amazon is still seeing more demand than it has available supply, and that's why we're seeing them, not just Amazon, but all the hyperscalers invest so aggressively to capture all this AI demand.
Dan, I want to bring in you here. Let's stick on that same thing and let's remind viewers. Amazon is calling for 2026 CapEx of about $200 billion. To Arun's point, that is far above what analysts had penciled in. Consensus was more like $146 billion. I think investors look at that, Dan, they say, okay, I want to know, I'm going to get some very strong ROI on all that spend looking ahead. Are you certain you'll get that, Dan?
I'm incredibly certain that that's coming. Look, these are very smart companies that have very good data, very good analytics, very good understanding of their demand. And basically, Josh, every CapEx estimate that's come from analysts over the last few years has underestimated what is required. Right now, Google, Microsoft, Amazon, Meta, they are all competing for the most compute. The compute is going to be the moat in terms of these companies being able to sustain their market advantages over the long term. Each of these companies understands that if they don't have enough compute, they will not be able to pivot quickly enough to the next thing. We're watching how fast new models, new services, new capabilities are hitting with AI. And of course, all of these companies are also servicing the demand of all their customers that need and want more and more compute. I was saw Matt Garman this week at the Cisco AI Summit, and I listened to him talk about how the A100, that's like a 4 generation old GPU from NVIDIA, is still at 100% demand. They have not decommissioned any, and they have not seen demand go down, and they've seen the spot prices continue to go up. So the demand for this stuff remains high. These companies need it for their moats, and Amazon got it wrong in the beginning. They underspent. They understand they cannot do that again. And the street is being maybe rational in some short-term perspective of how much these companies should spend, but they're being irrational long-term if they want to see Amazon continue to do what it does and protect its moat.
So Arun, as a financial analyst then, you're looking at, all right, this call for 200 billion. What are the signs? What are the signals? What are the metrics, Arun, you're going to watch to see whether this is money that's being well spent?
Well, I mean, first and foremost, we're going to need to see AWS growth further accelerate. I think now, given that they've spent a significant amount this past year, now 200 billion, 2026, street estimates for AWS growth is probably going to increase for 2026. That's number one. Number two, we're going to look at the AWS margin line, to really see if that they're getting that ROI, and that, near term there are some headwinds to margins when you're significantly ramping spending like that. But so far AWS margins have been pretty solid. I don't have it for this latest quarter, but it's been hovering around the mid 30% range, which is still pretty solid numbers. And over time, that AWS margin line could go above 40%. So we'll look to see if that how they can preserve that margin line in AWS for 2026.
Dan, I got to ask you, if I'm an investor, I'm watching this, tech pro that you are. I just heard Alphabet, all right? I just heard Sundar Pichai tell me he's going to spend as much as 185 billion. Now I got Jassy telling me about 200 billion. If I'm an investor, who downstream from this, Dan, benefits? Should I be am I looking at NVIDIA? Am I looking at Hock Tan and his crew over at Broadcom, Dan? What do you see?
Look, every part of the silicon supply chain is constrained. And right now, this should be sending signals like, right, if you want to penalize the hyperscalers for their near-term spending because you're concerned about margin pressures and you're concerned about the potential impact to their business, that's one thing. But you can tell there's some indiscriminate selling going on. Now, I think some of the semiconductors held up a little better today, but if you look at this CapEx commit, if you look at Sundar, you look at Satya, you look at Andy here, all of them are basically saying we're going to be spending big on NVIDIA. Of course, they're going to be building their own silicon, so that's great for Broadcom. I talked to Lip Bhutan the other day. He and I had an agreement on the memory. We're talking 28, 29 before those constraints lift. So Sanjay Mehrotra and the team over at Micron should be feeling very optimistic, as well as the rest of the memory, ecosystem. And then, of course, you have all the other parts, the packaging, the semiconductor equipment manufacturers, TSMC. I mean, you saw their numbers in their guide. There really is no slowdown in the spending. This is definitely an indication that the market wants to hear more clarity on where the ROI is going to come from. But clearly, these companies don't care. What they care about is they do not want to be outbuilt. And Amazon, Josh, and I'll leave you here on this, but Amazon knows this better than any, because Adam Selipsky's job was basically to get this right when he didn't get enough NVIDIA into AWS early enough. I think that's what ended up costing him his job. I think the fact they've been able to stand up Rainier, expand their capacity, and accelerate their growth to 24%, because they're facing 39% from Azure, 47, 48% from Google. They have to grow faster. They need more capacity. They have to spend.
Arun, you don't just have a buy on this name. You got a strong buy, my friend. You got a pound the table buy. When your clients ask you, Arun, okay, you're bulled up on this name, but what are the risks I need to think about, Arun? What were you telling them?
Yeah, I mean, the risk is really the elevated street consensus forecast. There are high forecasts here, and Amazon has to hit them every single quarter. I think Amazon also, they kind of shoot themselves in the foot a little bit because they report typically last out of all the hyperscalers. So sometimes a little bit more expectation there. But we still have a strong buy rating. Amazon. We talk a lot about AWS today, but both their retail business as well as their advertising business are both also firing all cylinders here. And I think the best, the strong buy opinion is really predicated on Amazon's margin trajectory. Its highest margin businesses, namely its advertising business, AWS, is growing at a much faster rate than the e-commerce or retail side of the business. So that I think, over the long term, over the next 5 to 10 years, we could see some significant operating margin expansion at Amazon. And they're close. I think within 5 to 10 years, they're gonna be above $1 trillion in annual revenue as well. So that's some significant earnings potential for this company that we still think trades at a relatively low or attractive valuation.
Dan, in the great AI trade and trend, there is this perception that Amazon is playing catch up, that it's chasing rivals, Dan, like an Alphabet. Is that perception fair, Dan, in your opinion? Is it accurate?
I think early on, and that's what I was talking about. I think they came out a little slow. They were leaning on their own infrastructure early before it was ready. They've made a ton of progress with Trainium. I think, of course, we're seeing this surging demand, and they got their NVIDIA capacity, scaled up. So they're moving in the right direction. We certainly saw a pivot in Cloud Era 1.0. Amazon, AWS was the largest by far. In Cloud Era 2, you can argue Azure and especially Google Cloud has been able to really build its own infrastructure. It's spent a decade on building capacity models, chips, and so I think they're playing catch up, but I think they're showing now the positivity of that massive base of business they had from the first compute era. As all these enterprises that rely on AWS are now starting to move to AI capabilities in AWS's cloud. This number's good. I mean, 24% from a very large base. Now, having said that, the expectations remain very high. And I will also say that Amazon is probably one of the largest potential beneficiaries of AI within their own business, and not just their cloud business, their advertising business, just like Meta takes advantage of, and of course their commerce business. They have robotics, they have physical AI at the edge, they have autonomous delivery. They have so much opportunity to pull margin out of that near $1 trillion of revenue we're going to see from them in the future, that I think that's part of the story that's being missed. And finally, for all the boomers out there that are, rotating into consumer staples and nervily moving out of tech, they've got a great play, because who doesn't have Amazon delivering at their door just about every day?
Dan, Arun, so good to have both you guys on the show today. Appreciate that instant analysis, fellas. Thank you.